It's kept artificially scarce. It's expensive because interest is charged for its use. And it's misallocated at its source, serving to concentrate power and wealth. And finally, it forces artificial growth. The compound interest formula mathematically is an exponential function. That means it grows at an accelerating rate. My first book, called Money and Debt, tried to exemplify that point on the cover with this curve that grows exponentially. That's the way debt is growing, and that is what is driving us to destruction. Now, it's legal tender that has caused an obliteration between the measure of value and the payment medium. Legal tender laws are an abuse of monetary authority. What they do is provide governments and banks with a way to avoid the discipline of the market. Improper and excessive issuance of money would normally be published in the market by discounting or refusal of the currency. But legal tender laws will prevent that. So the obliteration of the value standard by legal tender enables the abuses to continue. And the result, of course, is inflation. The only way that sellers can defend themselves against this abuse is by raising prices. Let me just give you a quick example, going back to that previous slide. When the United States government was first founded after gaining independence from Britain, there were certain elements within the founding fathers, Alexander Hamilton and his cohorts, who tried to replicate the Bank of England central bank model in the United States. And this is a bit of history that isn't very well known. But it manifested in the form of the first Bank of the United States, and then the second Bank of the United States, and finally in the Federal Reserve System in 1913. When the dollar was first defined at the beginning of the independent United States, it was defined to be 371 1/4 grains of fine silver. And that was a recognition of the fact that the currency in circulation in the colonies at the time was mainly Spanish-milled silver dollars. So in defining the United States dollar, they decided to take sort of an average of the silver content of the coins that were already in circulation. Eventually, however, that silver standard was obliterated by legal tender laws. When the government started to abuse its issuance power, especially during the Civil War, it said that you must accept these paper notes just as if they were silver. And of course, more notes were issued than the value of goods and services going into the market. So the result was a debasement of the paper currency, and the government protected itself from that debasement by instituting legal tender. So the point is that modern money is credit, and credit is the lifeblood of business. The common business practice is to sell on open account. That means if you buy merchandise from me, let's say you're a retailer and I'm a wholesaler, if you buy my merchandise, I will ship the merchandise and send you an invoice requiring payment in a certain length of time. That may be 30 days or 60 days or some other time period depending on the line of business we're involved in. So this credit that businesses extend to one another is a very important element in the business process. But we have to make a distinction between short-term credit and long-term credit. We have two distinct credit functions. We have the exchange function, which money is supposed to serve, and for that we utilize turnover credit or short-term credit. We also have the finance function. It's a separate but related function, and this involves long-term investment and savings. The two sides of the coin, savings and investment, are one and the same process. What a business invests is obtained by taking someone else's savings. So credit comes from the word credo, which means belief. All credit derives from a belief in something, and that belief is a promise. Credit is based on trust and contractual obligation. Who or what do we trust? Can we trust one another, or do we trust only the color of the money? Who deserves credit? Whose promise will you accept as payment? There are various sources of credit. Of course, we're all familiar with banks, and they give loans. But we can also get credit from customers, as I mentioned, with this buying and selling on open account. Prepayments, gift cards, gift certificates are also examples of getting credit from customers. And getting credit from suppliers and employees with vouchers and complementary currencies and open account. Now, the point was made earlier by Dr. Badil about the commons. One aspect of the commons that is rarely referred to is the credit commons. The whole monetary system exists on the basis of credit, and it's our credit. We give our credit to the banks, and then we beg them to give some of it back to us, and we pay them interest for the privilege. And this slide depicts that process. The credit commons can only be accessed through the banks by taking loans from the banks, and the governments have special access. There's this collusive arrangement between governments and high-level bankers. On the one hand, the bankers get to lend our credit back to us at interest, and on the other hand, the government gets to spend as much money as it wants without regard to its tax revenues. When you consider the United States government and its imperial activities around the world, the only way it can finance that is by borrowing. And if the borrowing from the OPEC nations and Japan and the other countries that hold American dollars is not sufficient, then the central bank will monetize sufficient debt to enable those deficits to be continued. So access to credit is controlled by the banking system in collaboration with the central government. The two parasitic elements then are interest, collected by the banking cartel, and the inflation caused by government deficit spending. Now, we need to consider that direct access to credit is possible and desirable. It's our collective credit. We have the power to use it in the way that we want, and we can allocate it to whomever we please. We have that power. Here's an example of the current process. Let's suppose you have 4 companies. Each owes the other $100. The only way that can be mediated, those debts can be discharged in the current system, is for someone to borrow money from the bank. So let's say the Alpha company borrows the $100 from the bank. It uses that $100 to pay Bravo. Bravo owes Charlie company $100, so it uses that money to pay Charlie. Charlie in turn owes Delta. It pays its debt with that $100. And Delta finally pays what it owes to Alpha with that same $100. However, now Alpha company has to pay back the bank, but it also has to pay some interest. That interest was not created when the bank made a loan. It can only be acquired from others through the marketplace, others who have also borrowed money into circulation. That means there's a chronic insufficiency of money available for everyone to pay what's owed to the banks. Here's the clearing process without bank credit. Let's suppose these 4 companies agree to use their own credit to clear their debts to one another. So Bravo accepts Alpha's IOU as payment. It then passes it on to Charlie. Charlie pays its debt to Delta with that same IOU. And Delta returns Alpha's IOU to Alpha, and all debts are now satisfied. Now, in a credit clearing process, however, we wouldn't be using Alpha's IOU. We would be using the collective credit of the associated members of the credit clearing system. So if money allows us to transcend the limitations of barter, credit clearing allows us to transcend the limitations of money. An association of traders can agree to offset purchases against sales amongst one another. In effect, whether we use money or not, goods and services pay for other goods and services. You sell what you have, you get money. You use that money to buy what you need. Money is just an intermediary. Another way to describe the direct credit clearing process is that we offset our accounts payable with our accounts receivable. So that same process can be applied not only at the level of individuals and companies, but also at the level of international trading. I'll say more about that in a minute. So how does clearing work? When you sell something, your account is increased or credited. When you buy something, your account balance is debited for the amount or decreased. It's like if you have a direct deposit account from your employer to your bank, when your employer pays you, that amount goes directly into your bank account. Your account goes up.